Welcome everyone. My name is Nandis. I'm from Dalrymple Trading. Today I want to discuss something that's been very close to my heart, which is the pitfalls of indicators and are they any good? I remember when I was starting off as a trader 15 years ago, indicators were, looked upon as the holy grail of trading, right? Obviously, we've come a long way since that time. And basically, I just want to review that and see if they're any good. But before we get started, what I want to do is just go through our risk disclaimer. So obviously the information provided here is just for educational purposes only, and obviously trading carries substantial risk and past performance is not indicative of future results. So just out of that, get that out of the way. So what we'll do is we'll first discuss the cons of technical analysis. What a way to get into the topic, right? So I'll go through these one by one, and I think it's worth mentioning each of these points because they really need to be embedded in terms of the drawbacks of technical analysis. As much as they have provided a really good contribution to the industry, there are things that inherently are drawbacks by its very nature. So let's go through these one by one. The first one is it relies on historical price data. So technical analysis assumes that past patterns repeat, but markets don't always behave the same way. What worked in the past may not work in the future conditions, right? So that historical aspect is what that's talking about. False signals are common. So indicators and chart patterns give misleading signals, especially in volatile or low volume markets. This can lead to premature entries or exits. We'll touch on that a little bit later on in the presentation. Third point, it doesn't consider fundamentals, right? So technical analysis ignores factors like earnings report, economic data, interest rates, or other geopolitical events, all of which can override technical signals instantly. So I'm sure you would have experienced some of these, even if you're not a trader. When the tariffs are imposed, prices shift and move, or when the interest rates get changed by the Federal Reserve, again, the interest rates, what you're paying on your house, etc. Those things change very rapidly. So on any of those news announcements, whatever you had in play with your technical analysis can quickly go out the window because of those fundamental factors coming into the equation. Number 4, subjectivity. So two traders can look at the same chart and interpret it differently. For example, one may see a breakout while another sees a false move or a reversal. So that's the problem with technical analysis, right? It's subjectivity. Two people can essentially see the same chart differently and they may trade differently, but there can only be one winner, so to speak, right? Only one person profits because it's a zero-sum game. The fifth one, which is very, very important, and we'll touch on a little bit later on, is that they're lagging indicators. So many technical indicators, like moving averages, are based on past data and react slowly, often giving signals after a big move has already started or ended. So by the time you actually get that signal, the move's already happened. Then the question is, how far along has it happened? Are you too late to get in now? Because maybe by the time you get in, the move has already ended, depending on the time frame that you're trading. Point number 6, over-optimization risk. So traders can fall into the trap of curve fitting, designing strategies that look perfect on historical charts but fail in real-time trading. This is a common one that I see with all my new traders. Trying to get that perfect system up and running, and lo and behold, when you look at it on the screen, it looks perfect. But once you actually put it to some back testing or you test it against different types of markets, the true robustness of that particular system gets unraveled very quickly. 7th one is market psychology can change. Technical analysis is based on crowd behavior, but sentiment can shift quickly due to unexpected news, causing price action to break away from the pattern. Once again, this goes back to point 3, which is around those fundamentals, right? So they sort of mirror each other in the messaging. So these are some of the cons that I've personally experienced and my students have experienced when it comes to trading as well. That's the feedback they've given in terms of technical analysis. And I can vouch for each one of these because I've experienced each of these at one point or another in my trading journey. So just for a bit of positivity, let's go for what it actually does help us with, right? So the first one is helps with timing trades. So technical analysis focuses on price action, support resistance momentum, which helps traders to decide when to enter or exit positions more precisely. I have to put a caveat around that because I think some forms of technical analysis do work hand in hand with price action and support and resistance, but some don't. So I'm talking about the ones that are correlated to the ones that work with price action and support and resistance. So I'm not talking about moving averages and the like. If anything, I'm discussing here like average true range, which tells you how much the price should move within a certain period of time. Or I'm talking about here potentially Fibonacci extensions, which are, I wouldn't say they're future looking, but they give certain levels. So those kind of technical analysis, I'll put into this bucket here. Positive number 2 works across all markets and time frames. Because it studies price and volume, technical analysis can be applied to stocks, forex, commodities, crypto, and more, on charts ranging from 1 minute to the monthly. So pretty straightforward. Number 3, visual clarity. Charts and patterns make trends, breakouts, and reversals easy to spot, giving traders a clear picture of market sentiment. We all know of this one, right? It's nothing like seeing a nice chart. The fourth one, risk management tool. So like levels like support, resistance, trend lines provide logical places to set stop losses and profit targets, which improves consistency. Number 5, captures market psychology. Price action reflects fear and greed and herd behavior, allowing traders to anticipate potential reactions without needing to know every news detail. Again, this sort of feeds off that, support and resistance, that sort of where the buyers and the sellers are holding. That's what it plays into. Point number 5, right? Number 6, quick decision making. Unlike fundamental analysis, which can take time to interpret reports and data, technical analysis shows faster reactions to market movements. Yeah, so we're not digging through troves of newspapers and company reports and balance sheets and profit and losses and whatnot. We're looking at the actual how the ticker, how the price actually moves. So that's what that's about. Can identify short-term opportunities. Even when fundamentals don't change, technicals can highlight intraday or swing opportunities based on prior movement. So that's pretty straightforward. So these are the pros and cons in my eyes of using technical indicators, trading indicators. And I think it's fair to say we've covered a cross-section of them. I'm sure there's a lot more, but these are the ones that come to my mind, and these are the ones that my students have told me are in the front of their minds when they think about technical analysis. Okay, now let's move to the next slide, which is basically where new traders get stuck. Now, I want you to post a comment down below if you think any of these apply to you or at what point they've applied in your trading journey. Now, some of this might be sort of new to some people if you're beginning to getting into trading, but for those that have been around the industry for a while, this would be old news to you, but it's worthwhile mentioning that these concepts are still valid, okay, in my view at least. If you disagree with me on any of these indicators that I'm going through or these highlighted styles that I'm going through, please comment down below. But for me, these are the ones that really, really got me stuck in my early days of trading. All right, so I'll start off with the first one, which is you come up with a magic set of indicators that will give precise buy and sell signals. Most likely you are curve fitting your profits to that style of the market, and you think to yourself that you've discovered the holy grail of trading. Haven't we all done this? Put some indicators on the charts, changes from one color to another, okay, signal down the bottom changes, and we finally go, okay, we figured it out. We've got the holy grail of trading, got it all under control. Only to realize that as soon as the market shifts, or at some point down the road, those indicators no longer give the same signals, and then you end up losing money. Now, what do we normally do? We add more indicators to what we already got, right? Or we tweak them, trying to see if we can get something else out of them that we didn't initially. But all of that is wasted time, because one thing, and I will say now, and I'll say as we go along, is that all indicators are a function of price, right? So price has to do whatever it has to do first before it can go into the form of being an indicator. Indicators just don't come out of thin air and suddenly present themselves on your chart. They come from price. So if we're not relying on price and we're just purely looking at the technical indicator, we already skewed the technical indicator, because half the time we're looking at historical data. So it's very lagging as well. So the first mistake I made was thinking that I discovered the holy grail of trading and I could be a billionaire and retire in the Caribbean. But unfortunately, that was not the case. I had to learn the hard way that that doesn't work. So please put aside the notion that you have discovered the holy grail, even if you get a couple of signals on your direction. Hold your horses until you do some back testing. All right. So the next one that I'll slide along to is the next slide. The next picture there is too many indicators. So has your chart ever looked like that? Multiple moving averages, multiple MACD, things crossing over on top of one another. That's a problem because now we're confused. We're not sure which direction the trade is going to move in. And different signals are being given by different indicators. One might show green and the other one shows red. So how do you pick which one is right? So this is another pitfall that a lot of new traders get into, loading up their charts with excessive number of indicators. Please don't do this. If you need to have an indicator, keep it to one or two at most. Okay, and don't just fill it up like this. It just doesn't work. So moving on to the next one. Okay, so this is a good one. Trading the wrong time frame. It basically means failing to see where other market participants are positioned. So for example, let's assume that you are a 1 minute trader. Okay, and it's an extreme, but let's assume that you trade a minute chart. You might have a buy signal on yours and you execute, but because you haven't looked at the higher time frame players like the hourly or the 4 hourly or the daily, they might be pushing a downward trade, or they're bearish and you're bullish. So you are actually going against the grain of what that trade is. So that's one of the other things that once you get sort of into that zone of just looking at purely indicators, you lose sight of the fact of higher time frames. And who are the higher time frames? Higher time frames are the large players, right? The hedge funds, the banks, the 401ks in America, superannuation funds in Australia, what have you. So they're the ones that are pushing price around. And if you're positioned against them, irrespective of whatever you're trading, then obviously that's going to be a losing trade because you're going against the moving momentum of that particular trade. So that's another thing that new traders get stuck in. And when it comes to figuring out the right time frame for you, I think it has to do with your lifestyle. I do need to address this, right? I think personally as a new trader, it's always best to go into it as a swing or long-term trader. Matter of fact, I think some people should be investing, putting in a certain amount of money every quarter into something like a Vanguard or an ETF. So if you want to trade, you're best off trading somewhat of a longer time frame because you're paying the same amount of commission to your broker through an in and out trade. At the same time, the moves are only so small that you're not really getting anything out of it. And I guarantee you most new traders have small accounts. So my suggestion for a new trader is always try to trade on a longer time frame, hourly, daily, 4 hourly, something like that, until you get really good practice, and that way go from there. Once you practice and you want to step down to a smaller time frame, of course, that's something you can do, but at that point you will know exactly what to look for in terms of your trading. But wait, there's more. I've only shown you 3. Let's go to the next slide. The next one is forgetting price action, okay, and support and resistance. So this means getting fixated on the indicators. You don't read the ticker. In other words, you don't read the price and you don't check for support and resistance. So here you're in autopilot mode. You're looking at what the indicators are showing you and you're just blankly following them. You have no idea of what price action is actually doing, right? This is a big mistake. So even experienced traders can fall into this, where you ignore the actual price action and just fixate on the indicator alone. So make sure we're not doing that. The next one's one of my favorites. This is the best trading indicators that you find on YouTube searches. I'm sure if you Google profitable trading indicators, you will find many, many indicators and many, many people that have uploaded certain strategies that they put. If they were that profitable, they would not be putting these strategies on the internet. And secondly, they simply don't work, right? They work for a certain market or a trendy market potentially, but as soon as the market gets choppy, you lose all the money that you would have made in the trend. So no, they don't work. I've tried them. They're good for a bit of fun, but certainly they don't work. So stay away from the ones that YouTube recommends you should be adding to your chart. The next one is somewhat, I would say, look, I wouldn't rule it out, but I would say that this is something you need to trade carefully. So trading patterns, right? So heads and shoulders, inverse heads and shoulders, rising wedge, descending triangle, God knows there's so many, okay? With these patterns, I've looked at a bit of statistics on it, and it says about 55 to 75% success rate. But I guess the toss of a coin is about 50% anyway, right? So the question is, what real edge are we having with certain patterns? Unless we put context into it. And this is why I said in my presentation here, with context, these patterns can be helpful. So merely trading a pattern because you see it, a rising wedge or whatever, you see one on your chart and you decide that that's the time to get in or get out, that's not right because you don't have the context. First, figure out what's the price action doing prior to getting to that descending triangle or what have you. And then if it does break out of that formation, where do you expect price to go next? So that's the sort of question you need to be asking yourself, not just seeing a pattern and then trading based off it. But looking at the other sort of indicators we looked at earlier, it is one that statistically has somewhat of a positive correlation for profitability, but it has to be done in a very calculated and wise way in terms of context. All right. So yeah, these are the ones that, I struggled a lot with. Okay. My biggest one that I struggled with was probably these two first ones, which is adding too many indicators to my chart and confusing myself. And lastly, figuring out that I've, discovered the Holy Grail. Now I can make a ton of money, print all the money in the world and retire. But the reality is that's not the case, right? If that were the case, it would have already been discovered. But there are successful people that use, certain technicals very successfully, such as Jim Simmons. If anyone hasn't heard of him, he's a trader in the US who's used automation back in the 80s and the 90s to become one of the wealthiest traders in the world. I think there's a book or something about him, The Man That Broke Wall Street or something like that. But anyway, he uses advanced mathematic modeling to actually get his trades to perform really well, to be profitable. He uses quants, so he's got a team. He's passed away now, but I know that he's used quants to get that kind of results. Pure automation, so you take out that discretionary aspect that as humans we have in our trading, that fear and greed. He's taken all that out, put it into a black box system where the system makes all the decisions, and it's been profitable for him. But unless we have a system like that, I think we'll always have to have some level of discretion, right? And that's where our trading plan really comes into play. Because if we have a solid trading plan, that means the amount of discretion that we have is somewhat restrained by the actual parameters of the trading plan. So creating a solid trading plan should be one of the things that you do first and foremost before you enter any kind of trade. Because I can guarantee you, if you enter a trade and it goes against you, right, instantly, your psychological reaction is to take action that is not in your best interest, adding to losers, things of that nature. So, these technicals, if you do choose to use them, make sure that they are part of your trading plan and they have, they're tied back to your trading plan as well. So now let's look at things that have worked for me, right? Let's try to get some positive out of this conversation. So the ones that have worked for me is the first one I will say is risk management. So no matter what strategy you're running, whether it's automated, whether it's discretionary, okay, whatever it is, the biggest thing is risk management. If you don't have this, you're not going to trade for long, because there will be periods when your strategy or your technicals will not work for you. Sometimes it just happens, right? You can't win in all markets, and that's just the case. But if you've got a solid risk management system that calculates, risk to reward ratio, putting your stop loss in the right places, you will be able to trade for a very long time and be profitable. So that's why I put it there first, because I think what does work is risk management. Even if you've got the worst trading system in the world, right? Out of 10 trades, let's say that you've only been profitable on 4 of them, and you've not been profitable on 6. If you do it properly, you will still break even or be profitable. So that's the stats. We can't argue with that. So risk management is critically important. The next one is price action. So price action is the ticker which shows real time in price movements rather than lagging indicators that aggregate historical data. Jesse Livermore read the ticker. Don't know if anyone's read Jesse Livermore's books, but back in the day, in the early 1900s, they didn't have charts. It was a ticker tape that used to come out. But he was a very profitable trader who just read that and made his profits. Now, I'm not suggesting that we read tickers. We've got data that can help us these days, but the principle's the same. You need to be looking at data that is current, the current candle that's forming. Sure, you can look at 10 candles back, but how does it help you in your next trade when the current candle is going to decide what happens next? Right? So just keep that in mind. Like, price action is so important, even if you are using indicators. The next one I've put here is technical analyst tools. Okay, and here I've just put simple tools that you can use, right? Trend lines, key levels, support and resistance. These have stood the test of time without much sort of addition or subtraction from what they are, right? So I've written here, the simplest technical analysis tools are used by the big players, your 401ks or your superannuation funds. They use key levels of price. They buy and sell into different tranches, liquidity pools. What do I mean by that? So all these large banks, they're going to basically use key levels. They'll buy at 60 and they want to push price to 70. They're not going to be sitting there with 50 different technical indicators as to which way price go. They will create liquidity. They will drive price to a certain point because they can't sell or buy everything in one go. They do it in tranches. Because if they do it in one go, A, it will show their footprint, okay? And two, they're not able to get favorable prices. So that's why you see a lot of situations where, people have their stops run, because you put a stop where some of these institutions will come and try to rebuy or resell. It's not that they're working against you. It's just in their interest to buy at that level. So it's always, these large institutions, they are trading based on levels. Okay, so they're not trading based on necessarily moving averages and things like that. They may use that to confirm, execute the trade at the end, but in terms of where they want to drive price, it definitely, you're looking at the macro factors as well that's driving it. So keep it simple. Use some technical tools like trend line, support and resistance. If you want to use Fibonacci, go for it. Or you want to use average true range, go for it. But, don't just, clutter your chart with a million different things, right? Let's keep going. The other thing that's worked for me really well is having a clear bias on regime. Who's in control? For what price are they in control? Your narrative should not change even if your trade is not a winner, unless the regime has changed based on pure price action. What do I mean by that? So at any point in time, the market has a regime, right? So either the bulls are in charge, either the bears are in charge, or it's an arm wrestle between the two, which is a sideways market. You need to be very clear which one of those regimes is in play. If you have any confusion whatsoever as to what regime is in play, step aside, don't trade until you realize who is actually pushing prices. Because if you are not sure of who's pushing the price, then you get in and it goes the other way, then you're going to be your statistics or your probability just goes down in terms of your profitable trades, right? Unless you are a mean reversion trader or something like that, which I won't go into in this particular presentation. But generally speaking, get a very good idea of who's in charge and make that crystal clear. And sometimes, the regime person, the people that are driving the regime, the institutions, you might trade with them, but all of a sudden there's a correction that comes. And you might think to yourself, well, now the trend has changed. It was bullish before, now it's bearish. It hasn't, most likely. What's happened is it's just a correction. And the bulls will come back again and buy. So it's really important to understand the difference between a correction and like a bear market, where it just completely changes direction, because corrections are a normal part of how prices move. That's important to understand. So the next one is around pure practice, right? Screen time. Like any profession, practice makes perfect over time. Your eyes pick up things more readily over time. So the more time that you spend in front of the charts, okay, the more experience that you will get in trading. Unfortunately, this is not something that you can learn from anybody. This is something that you have to do yourself. It's like driving a car, okay? At a certain point, you need to be able to drive on your own, and you will then check the things just to make sure you're safe. And in the same way, you will check the things in your trading to make sure you're okay. But that takes time and patience. So when you are starting off on your trading journey, don't open a big account, right? Don't risk too much. Risk only a small number of capital so there's longevity, and keep practicing. And once you keep practicing, there will come a point where you will break even and start to become profitable. At that point, you slowly increase your capital in terms of how much you invest into the markets, right? So the next one is backtest your strategy. Make sure you have a statistical edge. Your backtesting should cover choppy markets as well as trending markets to gauge robustness. Then make any tweaks as needed. This is very important. So your strategy might work, or your technical indicator, should I say, might work during a bull market and a bear market, but will actually lose money during a choppy market. So what do you do then? You might need to have another way of addressing that, right? You might need to have another approach. So that's why backtesting really helps. It allows you to choose a specific period of time across all ranges and then test it. And I know that TradingView has this service for free, right? Even not sure if it's free, but I know on the paid plans they definitely do have it. But it's great. We live in an age where we can actually back test our strategies ourselves, which is excellent. Back when I was starting to trade, unheard of. So this is really good. Like, I know what I mean by back then, I'm talking like 2008, 2009. Even then, that wasn't such a thing. But come 2016 onwards, back testing has become a real thing. So if you have a strategy that you believe has an edge, go and back test it. See for yourself if it actually does have an edge, and then go to the markets and then execute on a small account. That's the way to go. Right. So moving along. So what do I trade personally? So I trade my own money. I'm a swing trader, which means I don't do 2 minute, 3 minute, 5 minute, 10 minute. Usually I'm in a trade for a day, 2 days, potentially 3 days. Depends on where the price action is happening. I am a profitable trader, but like all traders, I can have down days. But on a quarterly basis, I'm beating the market. Okay. So I trade the S&P 500. I trade WTI crude oil. These are two markets that I've always had an interest in, and they resonate with me. With the antics that happen in the US, it's only natural that it's the markets move around with every time the politician says something like Trump. So that gives a volatility to the markets, right? Fed Reserve meetings, all of that stuff, the fun stuff. WTI crude oil, once again, like that's a good market to trade in because that's also influenced by geopolitical events as well. So even though I'm a technical trader, I still keep an ear out for what's happening in terms of sanctions or what's happening in terms of oil supply in the world. And I've said it's like driving a car. If you can trade one, you can trade others too. It's a matter of understanding the key nuances associated with each market. For example, S&P 500 is very sensitive to Fed meetings, and WTI crude oil is very sensitive with wars and sanctions. So my suggestion is trade whatever resonates with you. So if you like crypto and you want to trade that, go ahead. Just make sure you're aware of the nuances around that. Or if you want to trade, Forex, do that. But just make sure that you are aware of the nuances around that. You don't need to know everything on a fundamental level, but you still need to know what the key dates are when things happen. So you can, A, decide to trade or decide not to trade, because some news events can really affect what I said before, technicals, right? You might have a chart clearly mapped out and all of a sudden some fundamental news comes in and everything changes. So do it that way. So you're probably wondering, what do my actual charts look like? So this is what my charts look like. They're very simple. I use predominantly trend lines. I use high and low candles. Sometimes I use normal candlesticks. But I like to keep noise to a minimum, and I like to read the tape. Okay? Because that to me gives me real life information as to what's happening in the markets. And that's what I teach my students. I teach my students to step back, see what the market is telling you, because the market is always right. Whatever you have in your mind as to what the market should do, where they should go, how they should behave, that has no correlation or no significance in terms of our trading. We trade off the back of those large institutions. We try to catch their moves. It's like riding a surfboard. We try to jump on board with them. We're not trying to, surf against them. We're trying to surf with them in the same way. And that's what we're trying to do. And we manage our risk, because longevity in trading is everything. You can take one loss, you can take two loss. But if you get a huge loss that takes up, three quarters or most of your account, you're psychologically going to be so bruised that you lose your confidence, and it's going to take you more time to get back into it. So trade small, right? So, which takes me to my next presentation slide, which is around, where do you find more information? So if you enjoyed what I presented today and you feel like you can get something for yourself in terms of knowledge, I offer, one-on-one trading coaching sessions. Now, I could have done, when I was thinking about doing this business, I thought, I could have done a actual course and then charge for it. And every time someone buys it, I make money from that course. But there's a lot of courses like that, and they're good. There are some really good ones that I've done myself, right? So I'm not dissing them. They're really good. But what I will say is that they don't do a one-on-one interaction. They don't look at your particular needs in terms of how your mindset is when it comes to trading. So in my course here, I tailor it to your situation. So I do an initial free consult. So you call, we talk over Google Meet or Zoom, what have you, and then we see if you and I can first of all work together, and if there's an opportunity, we'll work on that. If not, that's okay. I'm sure that I'll get something out of that phone call too, as much as you do. So those sort of calls are still very helpful to my even growth and development as well. So, but if you do decide to take the course, basically what we do is we go into the introduction of the markets and identify market trends accurately. So this is important. This is where the real money is made. Right? This is where you identify the trend, and not just looking at a simple not just looking at just a simple indicator. It's just looking at what is the actual trend, who's actually in control, which runs into point number 2, understanding market control, buyers and sellers. So we really wanted to understand who is moving the markets, right? And I'll just go back to the diagram below. So in here, you can see that I've underlined a bull regime here. This is the S&P 500, by the way. This year, at the time of this recording, I've said that we're in a ripping bull market. But here, back in around end of June, we saw a big bull move all the way up through there. Then we had a correction, okay? Significant correction, but not a bear market, a correction. And then we had the bull regime go again. And then these are points of entry where I've marked out in the green arrows where possible traces to buy. And now we see price pull back. Okay, that's a correction too, what we're seeing right now. But looking at that chart, would I be bearish? No, because until this 6,200 level is broken, the bulls are still in charge. So any shorts that you're taking here, yeah, I'm sure you can take it and make some money. That's fine. There are traders that do that. Respect to them. But the reality is that this is a bull market and you need to be trading with the direction of the move. So I'm looking here at some point to execute a long trade. Now, that's based on other things that I look at as well, not just this chart, but it shows you how my mind works when it comes to this particular chart, right? So that's what I mean. Understanding market control, the buyers and the sellers, who's really in control. And I've seen here whales, right? The whales are the ones that control the shift in the direction of the markets, the large institutions. Then we talk about risk management and trading psychology. So here we go through actually position sizing, okay, based on what you're working with. And remember, my course is also can be done by investors as well. It doesn't have to be just for traders. I forgot to mention that. It can be done by investors too, because how much you decide to invest on a quarterly, monthly, weekly basis, you can work out as well. And a lot of the things that we teach in this program, or what I teach one-on-one, is still relevant for investors as well, right? Because you're taking this, you still want to buy in good positions. You don't want to buy in a bad position. So risk management and trading psychology, we go through that, okay? We look at even AI on that front as well, how that can help us with our trading. So all of this, modernizing, ChatGPT can help quite a lot with certain things these days. So going to number 4, matching strategy with lifestyle objectives. So here I'll be looking at, what your actual lifestyle is. Are you working full-time? Are you working part-time? Do you have a family? How much time can you commit to on a daily basis towards your trading? Now, if it turns out that, you don't have a whole lot of time, then it could be the fact that you focus more towards being an investor or a swing trader, which is more than reasonable, right? So that's really good. And we also look at ETFs if you want to go down that road, exchange traded funds. It's a great way to, get into the markets and not have to worry about things. You just pick a good spot to buy and then just let it do its thing. Of course, check on it from time to time, but it just looks after itself. But if you're an active trader, again, all these things work the same way. These are the same instructions for both investors and traders. The way I coach these elements will be a little bit different, right? Because it'll be dependent on your particular lifestyle, but the principles will be the same. And point number 5, which is very important, is developing your custom trading plan. And here, we'll sort of do a 360 on all the stuff that we've learned, points 1 to 4, and we'll develop a trading plan that's unique to you and your situation. And it has to be something that you can work on, and we'll actually formalize it, okay, in a document. And every time you execute a trade or you carry out an investment, you will refer to this document to basically give you the instructions to buy or to sell to manage your trade. All right, we can tweak it as we go along, but that's your Bible as far as that goes. Okay. Now, so after these 5 sessions, you might be thinking, well, I've got all this knowledge. My suggestion is go and practice for a while. And once you've practiced, you've got more questions, you can always come back and ask further questions, right? So this is what we're offering. I know I've sort of gone a little bit extra than what I should have, but I'm very passionate about actually sharing my knowledge with new traders, especially. And for those seasoned traders and investors, I'm more than happy to, obviously share and collaborate together in terms of, building on those skills and learning from each other as well. So if you want to follow, I'm at Instagram at Dalrymple Trading. My website is www.dalrympletrading.com. If you found what I presented today helpful to you, please like and subscribe. Please give me some feedback. If you want me to do another video like this again, I'm more than happy to do it. Just pick a topic and we'll go through it. Have a good trading. Take care.